Hi, good morning, everybody. I'm Ernesto Burden, the publisher of New Hampshire Business Review, and I'm happy to welcome you to Managing Your Investments in Times of Crisis. This webinar is going to look at how the coronavirus is impacting your investments and what kind of impact will it have as we continue to deal with this pandemic. In a moment, I'll introduce our editor and presenter and moderator of this panel discussion, Jeff Feingold. But first, I do want to thank the New Hampshire Business Committee for the Arts for sponsoring this. And I want to just give you a little bit of information about an event they have coming up. The New Hampshire Business Committee for the Arts invites you to its annual Business in the Arts Awards on digital stage with a week-long virtual celebration of the arts from May 11th through the 15th. The NHBCA's signature event recognizes businesses of all shapes and sizes, individuals as well as organizations for working together to build some of New Hampshire's most vibrant, diverse, and prosperous communities. So go on over to nhbca.com to register for your backstage pass to this one-of-a-kind awards event. Be among the first to know who made the biggest splash with their contributions to New Hampshire's robust arts and cultural scene last year. This year's nominees come from every corner of the state, including Keene, Lebanon, Concord, Nashua, and Exeter. Make sure you are part of the excitement. Sign up today at nhbca.com for your VIP access to the 36th Annual Arts Awards. I just signed up this morning. I'm very excited to support this organization and to see who wins this year. So with that, Jeff Feingold, editor of New Hampshire Business Review. Jeff, take it away, and I am going to depart and listen quietly from the sidelines.
Thanks very much, Ernesto. Not for signing off, but for introducing me. First of all, I want to say thanks everybody for attending this, our second webinar, and we're really excited about this. We have a great panelist to talk about how to manage your investments in this time of, well, crisis is a good enough word. I think sometimes it might not be strong enough if you follow what's going on in the markets lately. And actually, I want to, if Emily or Ernesto could put those charts up that I pulled out. I pulled off actually from CNBC showing the volatility of the three major market indexes, the Dow, the S&P, and the NASDAQ, to just show how it's been just like a roller coaster the last month or so, as we all know, including every member of this audience, I'm sure. Anyway, first of all, I'd like to introduce our panelists who have really graced us with their presence, because I'm really excited about listening to hear what they have to say. First, we have Elizabeth Salas Evans. She's a finance industry veteran and currently the president and chief compliance officer at Cayena Capital Management. Her career spans positions ranging from trader and broker to trusted advisor and portfolio manager at TD Ameritrade, Fidelity Investments, and Charles Schwab. And Elizabeth was recently named a 2020 Outstanding Women in Business by New Hampshire Business Review. So welcome, Elizabeth.
Thank you for having me, Jeff.
And then we have Bob Bonfiglio, who was a certified financial planner, private wealth advisor, and chief executive officer at Rise Private Wealth Management, which is based in Bedford. Bob has more than 30 years of experience in investment advice. And Bob, also, I don't want to neglect saying that you were once our Business Excellence Award winner a few years back. So we have some award winners here. And now Casey, who hasn't won an award yet, I'm sure will. D. Casey Snyder is a certified financial planner and partner and senior vice president and wealth manager at the Sedoric Group of Steward Partners, and their office is in Portsmouth. Casey began his career in personal finance over 15 years ago with a dual degree in psychology and sociology, which obviously comes in handy right now these days. The two disciplines that he says are essential in helping individuals and families manage their financial affairs. Thanks all of you for being here. I guess first I wanted to start out with a softball question. Yeah, we're looking at those charts of the volatility, and anyone who has money in the market, whether it's through their own investments, investments that they oversee, or just a mutual fund or a 401k, IRA, whatever, is aware of what's been going on in the market. So here's my easy softball question. What is the most important thing an average investor should think about as we weather this crisis? And would anyone like to take it first, or should I just say Bob? Bob, why don't you take it first?
Sure.
Thanks, Jeff. Yeah, so I think that you really want to focus on your plan and what your goals are. And every goal and plan would have, along with it, a time horizon. And as long as your time horizon is longer term, and when I say longer term, say 3 to 5 years plus, you really want to stay calm about this and not make too many changes. So it's just kind of like if there's boaters out there when you're boating and you want to focus on the horizon and not, kind of in the midst of the waves that you're in. And that's kind of what we're in right now. We want to focus on that horizon out there, where our goals are. So you really want to stay focused on that and stay true to your plan. Also, a plan, any good plan would have a cash reserve and would have a game plan for uncertainty. And there's a lot of uncertainty right now, so we plan for that and we set up for that. So as long as you have a good game plan, you want to stick to the plan.
Yeah, and I can echo that sentiment in terms of it being extremely important to stick to the plan that you've created for yourself, while also considering what your needs are today. So it's important to consider how you've been impacted by this pandemic. And, if we had this conversation in August of 2019, I was still hearing financial advisors and portfolio managers saying, hey, the market's going to keep going up. There's nothing to see here. And so implementing plans that were set for continuous bull markets, continuing growth, and didn't really account for a recession and what I feel is going to turn into a depression. So I think it's important to consider what the needs are today and what you need from your portfolio, because there is, as Bob had mentioned, a percentage of portfolios, most portfolios that are in cash, but it's extremely important to recognize if you need more of that percentage in cash, to have that to allow for you to sustain yourself in the next year to 2 years. And beyond. And that also considers, will you see yourself losing your job? We have 22 million people, Americans, out of a job. So certainly I think that this was not what advisors, portfolio managers were saying if we were just looking back simply 9 months ago.
Great, thanks. Casey, what are your thoughts?
Yeah, and I'll just piggyback off of both of that in terms of, I think it would benefit the average investor to look ahead and maybe to the year 2022, because if you can find a point in the future to be able to focus on, it helps you then sort of back into the answers of what do you do today, and all of that's meant to be in alignment with your plan. So I say 2022 because the average length of a recession or bear market, and a recession and bear market are two different things, but often coincide. By 2022, we're apt to be in some stage of recovery. Early stage, mid stage, late stage, no one really knows. But then you can ask yourself the question of, what do I need to do, or what does our family need to do to bridge the gap from today to 2022? And it gets into, which Bob and Liz just said, is stick with the plan. What's the emergency account like? How might your financial needs evolve should something happen? Do you have the emergency account? Do you know where your cash flows go? And use this as an opportunity to really focus on the elements of your plan that you have control over. So if you continue to save, are you saving in a way that creates future tax flexibility? Don't waste a lot of time worrying about the unknown that no one has an answer for over the next, couple of weeks, couple of months. There's no answer for it. So focus on what you can control and continue to execute that strategy. And the only way to do that is with the comforts and the confidence that you're going to be okay in the near term. And if you discover you may not be, what do you need to do to address those issues?
That's great. That actually raises a second question, a follow-up. What happens if you don't have a plan, or your plan is just destroyed by what's been going on the last month or two? Well, I mean, what is the option? What is the option for that?
So, I'm happy to start. It's if your plan has been disrupted by means of what's going on, I think it's a matter of still looking inward versus looking outward. And all too often, people try to hyperfixate on things that they cannot control, rather than really looking at what are the items of our financial plan. Is it a good time to refinance? Do I need to bulk up my emergency account? What are the things that we can take control of and that will help us either tread water or get back on track? It's never too late to start this process. It is too late though to prepare for an event that we're already in the midst of, per se. That legwork went into effect, or you went through all those steps in the years leading up to it. And so now it's a matter of, well, how do you plan for the next 3, 5, 10 years?
Okay. Does anybody else there have any thoughts on this, or?
Yeah, I agree with
Go ahead, Liz.
Casey, with what you were stating in terms of really looking at, it's hard to plan when you're in the middle of chaos. However, it's important to, again, go back to what you need today. And everyone's in a different situation. We have individuals that don't have access to food, don't have a job. They just lost their job, so they didn't foresee themselves losing their job. So I think it's important to go back to what it is that you need, what it is that you can control, and what it is that you need to get to that next step. So if it's access to unemployment benefits, if it's calling your health insurance to check your benefits, if it's looking at your savings account and checking account and looking at your 401k, in terms of if you're needing to withdraw from it, and if not, then it's really important to look at your portfolio to see if you need to make changes to it to adjust for the longer term. And so depending on where you are in your life and what the needs are, such as myself, I have 2 small children. My daughter's in preschool, so adjusting to doing homeschooling is something that is new to a lot of us. And then finding, to share a 24-hour clock, I think it could be kind of foolish to say to somebody, well, fit a portfolio review into all of that when you're also trying to do your day job and then homeschool and feed your kids and everything else. So I think it's important to hit pause to think about what it is that you need today, what it is that you need tomorrow, and then beyond, to be able to break it down in digestible ways that don't invoke more fear and just complacency based on that impact.
Great.
I was just going to add to that, Jeff, that, it depends on where you are in your time horizon too. So like for our retirees, we like to keep anywhere from 3 to 5 years of money that they need over the next 3 to 5 years in either cash or fixed income or certificates, just in preparation for something like this. And because we're going to see a downturn like this every 8 to 10 years, you see a bear market. So we know there's going to be uncertainty, so we want to prepare for that. We're certain about that uncertainty, so that's one of the ways we prepare them. And if you're younger and you're still saving for retirement, you actually should be relishing these times because stocks are 20% off right now. They were 35% off a couple of weeks ago, and they're on sale. So if you're younger, you probably want to step up your savings and take advantage of this so that long term you'll make out.
Great. Now, I just want to, first of all, I wanted to just say to the audience that you are more than welcome to submit your questions. We have a few of them now, and it's great that, that's why we have our panelists here for you to submit your questions yourself, because, I have a lot of them, but I always have questions, so I get to ask them all the time. Anyway, you could do it there's a little chat, there's a place on the screen, you can see where to submit questions. All right, you mentioned something about retirees. Now, if you're living on, as a retiree today, the thing that's most glaring to me, and it's true of the last several years, obviously, but it's been even more exacerbated recently, is interest rates. Now, how does that play? What's the role of that, the interest rates in this strategy, especially for retirees? What is their option, or do they have an option?
Yeah, I can take that first if you like. You're right. Back in the day, you could get 8 to 10% on a CD and put that away and live on that interest, and everything's guaranteed. Well, those days are gone. So one of the things to look at is dividend-paying stocks. So if you think about Verizon, a company that I'm sure we're all familiar with, probably a lot of us have Verizon for our cell phone service. Back in 2009, the dividend for them was 3%. Today it's 4.5%. dividend, right? So the dividend's grown by 33% over the last 10 years. The stock price back then was $25 a share in 2009. Now it's about $56 a share. So meanwhile, the 10-year treasury is at something like 0.7, 0.8%, so less than 1%. So you can invest in a guaranteed treasury and get less than 1% over 10 years. Or in the case of Verizon, over the last 10 years, the stock price has doubled and the dividend's gone up by 3%. So that's just kind of a proxy for some, these companies are still paying dividends, good dividend paying stocks are still paying dividends, and basically you're getting paid to wait out, wait out the market. Now, you don't want to have all your money in dividend paying stocks. Again, what we do is we take 3 to 5 years of money that our clients need in their retirement over the next 3 to 5 years, and that's out of the market completely. But these dividend paying stocks can help provide funding that you need on a regular basis.
Sure. So I think it's important to consider going back to the needs of what the purposes of the money. And in terms of short-term interest rates right now and long-term interest rates that are, as Bob mentioned, at really just the lowest levels, where I think what we know is that if you put money into your bank account, you're most likely going to be negative yield, especially if you do have bank fees. But in most cases, if you don't, then you're going to be earning pennies, almost nothing. But then it's really going back to what you need those funds to do. And so if you are living off of those funds, or you're needing them, whether you're emergency funds, those should really stay in savings and should really stay as liquid as possible, no matter how hard it is to deal with how low the interest rates are. Certainly, there are banks out there that offer promotional rates on CDs through brokerage firms, as well as investment managers. I can buy some brokered CDs that offer a little bit of interest, treasuries, and certainly when it comes to interest rates right now, I can't help but think about the liquidity issues that are going on in credit markets with regards to how low the interest rates are. Banking institutions are issuing a lot of debt and lending at very low rates to companies and corporations and municipalities just to be able to keep their doors open in the current environment that we're in. So we're not in a normal environment where you would see, low interest rates, or even thinking back to 2005 and 6 when you were seeing 5-6%. We saw the rates cut to zero in 2008 and 9 by the Fed and federal former Fed Chair Alan Greenspan and Ben Bernanke. And so, we are just not in an environment where I think people need to be taking additional risks with their assets, particularly if they need them or if there's uncertainty in the next several years with those assets, particularly if somebody's nearing retirement or in a position that they may lose their job.
Great, thanks very much, Liz. Casey, did you have some thoughts on this?
Yeah, and this is a loaded subject. I mean, so we've been talking about this as the low interest rate dilemma. And Ernesto, I don't know if you have access to this. I think it's page 3. But the fall and the decline of interest rates, this is just a snapshot. It's got a 700-year history here. And it's the trend line that's most important. And the trend line shows the continuous decline in interest rates. And to what Liz just spoke to, the significant amount of debt that's already on government balance sheets or municipalities, and when we think about the amount of debt that is going to be borrowed, or the amount of debt over the next 10 years, low interest rates are apt to be with us for a while, and it throws a monkey wrench into what Bob spoke to, is that many investors and savers always had this idea of this 5-6% relatively safe return come retirement. So the discussion that we've been having for a while is the need to reframe risk, which is what Bob just outlined with the Verizon example, is we may not be able to rely on sources of the past in a way that we'd always expected. And if we're going to have to rely on other sources like dividend paying equities and or accept lower rates of return from that conservative portion of our portfolio, it means that our plan and portfolio have to be very durable. If we're going to risk up with equities, pay the income stream, it means that the plan, our risk capacity in our plan has to be able to account for higher volatility. Otherwise, we need to, find compromise with working longer, saving more, other ways of trying to account for this lower return environment. And we also, in the background, and this is really important, have to find that balance of not just risk capacity in a plan, but what's our emotional tolerance for the volatility factor here? Because if we ignore the emotional component, we're apt to fail at some point because somebody may become reactive at a time when they really shouldn't be. So the low interest rate dilemma to us is really one of the key themes as we think about the next 5 to 10 years and maybe beyond because of the potential implications of it. So,
Jeff, just one follow-up to that. On the flip side, with these low interest rates, provide a pretty huge opportunity for anyone with a mortgage. Just before this webinar, I was on the phone with my daughter. She bought a house less than 2 years ago at 4.6% mortgage. She's looking at getting into the 2s right now, and with the possibility of getting rid of PMI. So that could be a huge cash flow savings for her. So at a time when we're looking to preserve cash flow and maybe look for other ways that we can invest, that's a good opportunity.
Yeah, and just to to that point, I think the theme that's consistent here is looking inward and controlling the factors or the variables that we have control over. And so a lot of our discussions over the last 6 weeks haven't been about what the S&P or Dow or anything in terms of their day-to-day volatility metric. It's a matter of, should we refinance? Should we pay down that debt? There are a lot of pieces that either further our progress financially or weaken our plan kind of slowly. So.
Right now, I'd like to turn to some of the questions coming from our audience members. And one of them, I think, plays into this whole idea of, I guess, tolerance of risk. It's, what do the panelists think about owning international stocks at this time? Do you have any thoughts, Elizabeth?
Sure. So in terms of interest rates and international stocks, so it's a very interesting correlation. And so when we think about interest rates, we have to consider who's getting low interest rates. And so as Bob had mentioned, investors, refinancing mortgages, borrowers, and so institutional borrowers, corporations, central banks. So on the international side, that's how governments exchange money, is through central banks. And so interbank lending, which is done at very low rates. And so we're seeing central banks around the world cut their interest rates. So Colombia, they cut rates this morning. Uzbekistan had cut rates this morning. We're seeing rates being cut across the board globally. And so what this does is it provides more liquidity to these economies, which actually could serve as a benefit to emerging markets, as well as international companies and multinational companies. Now, certainly there is a higher level of risk when it comes to investing in multinational companies and overseas, but certainly I think it's important to recognize the importance of diversification within a portfolio and also your timeline. But in terms of international and emerging economies, I think that there's a lot of opportunity given the lower rates and interbank lending.
Yeah, and if I may, we see opportunity within the international markets, not just because they're relatively inexpensive or were relatively inexpensive compared to the U.S., but also they have a tendency of paying higher yield. So when we think about this interest rate dilemma and retirees needing income, the foreign markets are providing an average yield, whether it be international developed or emerging, that are on average pretty significantly higher than here in the U.S. So that's a component of this reframing of risk. If you need a 4 or 5% income stream, where do you go? Or 3 to 5% income stream, where do you go? Well, the emerging markets or the international markets may be attractive, but there comes a higher volatility metric again, which is why you then need to be able to balance that out within your plan in other ways.
Yeah, and I would just, you guys both have mentioned it, but it's international stocks are just a part of a diversified portfolio. So we always have that as part of our portfolios, and just depends on the risk of the client. So we are keeping that. Although we're underweighting international right now, so we've trimmed a little bit of our weighting toward that. Just feeling like coming out of this, the U.S. is going to be a stronger player than some of the international stocks, but we always have it as part of our portfolios.
Well, here's a related question. Historically, a financial plan was based on an investor's risk tolerance, producing a bond equity ratio. However, bonds are now very risky with low interest rates. What does this do to overall planning? Casey, you're smiling, so.
Well, yeah, I mean, sure, it's a great question because of this, again, coming back to this low interest rate environment. I will say real quick is that, you know, there's a big difference between risk in the fixed income markets and risk in the equity markets. So, you know, fixed income markets are naturally much more conservative than equity markets. But the reality is that, yeah, that balanced portfolio of today is apt to generate a much lower return than it has over the last 30, 40 years. And this comes back to having to find, I think, some sort of compromise, whether it be in the plan itself, spend less, work longer, save more, you know, vacations every other year, you know, some sort of compromise there. Or our emotional tolerance for volatility has to evolve in a way that allows for greater exposure to equities. And this is a balancing act. If you overweight any one direction, you kind of throw off the plan or are exposing yourself for trouble. This is the dilemma, but it's not just a dilemma at the household level. It's a dilemma for pensions, for endowments. You know, this is a global dilemma. It's almost as if the world coming into this was in a position as to where they needed above average or average returns. And the world is now priced in a way to deliver average or below average returns. So it's a dilemma that we're all grappling with, and everyone's answer, I think, to that question will be unique to their own plan and circumstance.
Yeah, so I think that, so right now credit markets are getting completely slaughtered. They've been in the worst decline since the Great Recession, where there's not enough money flowing through the credit markets, and you're seeing bonds trading at a significant premium on both corporate and municipals because of the fact that you are looking at the same companies that you're thinking about buying on the stock side are also the same companies that are issuing bonds and looking for you to invest. So we look at credit ratings to see, is this company even going to be able to survive this next cycle and the recession that we're in? And so we're seeing a lot of bonds that are being sold that are up for potential downgrades this summer by Moody's and Standard & Poor's. And so what that does, if these are pension funds and mutual funds and trust funds, as Casey had mentioned, that are holding funds or municipal and corporate bonds that are above investment grade or investment grade bonds, and they get downgraded to now junk status to below investment grade, then you're going to see an exodus of all of these funds and you're going to lose a ton of money. So as a tactical investment manager myself, I use asset allocation as a base, but I move above and below targets in times of volatility. So right now, I am picking up some municipal bonds, very few corporates, but I'm actually using cash right now as my fixed income position because I was seeing too high of a correlation between my intermediate and long-term bonds and the stock market, particularly as we saw the Federal Reserve of the US inject 1.5 trillion into the overnight market and establish 5 to 6 new organizations to be able to continue funneling money into the credit markets because there is not enough, and that's on a global level.
Thanks very much. Bob, did you have some thoughts on this?
We've been getting this question really for 10 years. You know, 10 years ago, we were getting the question, oh, the interest rates are going to go back up. And, you know, Casey showed the chart, you know, it just continued to go down. And so You know, and when things are going well in the stock market, people ask, you know, why do we have why do we have this fixed income stuff? It's not doing anything. Well, you know, the fixed income has, you know, performed pretty well, but, you know, you can't paint bronze in just a broad brush. There's a lot of different kinds of bonds. So particularly treasuries right now have done well, you know, and saved a lot of portfolios. So you do have to have that balance. We don't know what's going to happen in the future. So again, it's just part of a balance, and everyone's saying the same thing. You got to have, you know, assess your risk tolerance and adjust that portfolio as time goes along. But they do play a place to help. I mean, I'm looking at a chart here on how we rebounded out of the 08-09 crisis. And if you had a 50-50 portfolio in 08-09, it took about 18 months to get back to even. You know, the stock market, if you had 100% stocks, it took you a lot longer to get back to even. But 18 months later, with a 50-50 portfolio, you're back to even. So it does play a part.
And
Yes.
one,
I'm sorry.
yeah, one rule of thumb to keep in mind for anybody listening, investors, that the longer the duration, the longer the maturity on the bond, the higher the volatility.
That's a good point. Speaking of that, it's, I think, of a related question for one of our audience members, asking someone or all of you to speak specifically at the impact of this market on pension plans. Does anyone have any thoughts on that? I know you touched on it briefly, but maybe a little more specifically about what this means for pension plans.
Well, just the whole downturn in interest rates over time has really kind of crippled pension plans. So they're looking for, just like all of us, they're looking for alternative ways to generate return, because they don't want to create too much risk. And I think that's been part of the reason that over the last 10 years, we've seen really most companies are trying to get out of the pension business and not have that liability on their books. So, you know, I just think that trend continues. Really, unless you're grandfathered into a pension, the only people that have pensions right now are people that work for the state or the federal government, because most companies are not offering pensions to new folks.
There are still, I know people, they exist. I mean, they're like rare, like dinosaurs. No offense to the people getting them, but you do see them every once in a while walking the earth.
Yeah, most of them are frozen. You know, they're grandfathered in. There's a few companies that still have them, but it's the exception rather than the rule.
Right. You see a lot of insurance companies offering pension plans to employees, as it would be obvious. And pension plans are insurance contracts. So they are annuities. And so a lot of the times you see insurance companies offering a pension such as Liberty Mutual to employees. And, you know, but certainly, yeah, they're a dying breed. They have been for quite some time. Companies such as General Motors, who already went bankrupt, but, you know, round again, round two, they've already tried to refinance their debt to try to pay their pensions that are coming due. So as we see companies go bankrupt through this recession that we're currently in, I think that we're going to see pensions just, again, just completely dissipate. And a lot of people beyond who are suffering today, I think going to suffer more through the loss of their pension. And we don't even know if the individuals that have been grandfathered in that are receiving pensions for years and years, if they also go bankrupt, then how are they going to service those? So I think that we are in the middle of a crisis with a lot of uncertainty. We are in the middle of a recession, and right now, as an economist and investor, it's going to turn into a depression. And when we're looking at 18 months out for a possible vaccination for COVID-19, I think we have to consider, you know, can companies keep their doors open for that long?
Great.
Yeah, if the municipal pension situation has been on our radar for a while, and it's an underlying concern for us, to the points just made. The municipal world has been pretty significantly underfunded. Some states are in better condition than others. The FT did some analysis, so the Financial Times did some analysis a couple years ago. The Volcker Alliance out of New York, Paul Volcker's nonprofit, has done some significant work in doing a deep dive into how well funded state and municipal pensions are and the dilemma that they face, especially with the low interest rate environment that we're living in. This, I think, kind of bridges into a subject of higher taxes are possible and or likely, because at some point compromises are going to have to be made as it relates to can the pensions follow through with what they've promised, and or how do they raise additional revenue to make true on that promise, or they're going to be forced to cut benefits or cost of living adjustments or something. You know, there's change on the horizon, and the depth of this recession and or depression, whatever this turns out to be, will only further that dilemma and the strain that's put on the states and then trickles down to maybe the taxpayer. So a lot of uncertainty there.
You know, speaking of, you mentioned, Liz mentioned the word twice. You mentioned it once. I wanted to follow up on this. You mentioned this idea of we're looking at a depression. Now, Liz, could you define, first of all, what's the difference between a depression and a recession?
Sure, it's a great.
And just take it from there, what exactly you're talking about.
Yeah, so a recession is significant declines over continuous quarters, usually 2 to 3 quarters of a decline in economic growth. So GDP, looking at CPI, Consumer Price Index. A depression is something that's sustained longer, so a longer recession for multiple quarters, 6 months, 6 quarters, over time, longer term, as we saw in the 1930s. And so in terms of the impact that we're currently in, Consumer Price Index, which is a measure of inflation, which takes a basket of goods, purchases that we all buy every day to survive, and it measures the changes in prices. And so when we see a decline in prices, then we have risk of deflation, which means that we have negative growth, which means that we have contraction. And so if we see that for a sustained period of time, and again, if we see that over, an 18-month period, then that would be a trigger of a depression. If we see 2 to 3, 4 quarters, a full year to a year and a half, then that's really recessionary periods. So certainly right now, we are seeing high risk of deflation. Certainly when it comes to the BLS, who collects data for CPI, 50 to 75% of the data that's collected is done in person. They cannot get out to collect the data. So they've had to adjust using estimates from whom they were able to meet with to get the data based on prices of goods. So they're expected to continue to contract. So certainly looking at CPI, looking at just prices, certainly I know there's been a lot of attention on oil right now and OPEC and cost of crude and commodities. And certainly we're seeing a flood of oil through OPEC, which was flooding the market, driving the prices down. And so certainly I think that has been quite distracting when it comes to the other indicators that are a better gauge of the economy in terms of CPI.
Did any of Casey?
Go ahead, Jeff. Yeah, I mean, I refrained. There's a great deal of uncertainty about how the next 6 to 18 to 24 months play out. I think what's unique about the oncoming recession, or whatever it morphs into, is that it's not because the economy was overheating and one specific sector just exploded, like the tech bubble, or an underlying housing crisis and suddenly nobody knew what anything was worth. This was an unforeseen pandemic, which then triggered a policy response. So in some sense, the oncoming economic event, the one that we're already in the midst of, was artificially induced because everybody was told to stay home. So the way that this plays out may be different than past recessions because it's not following the normal sort of a sector or economy overheated and then blew up. And given the resources that are being thrown at this challenge, at this problem, the $2 trillion plus for stabilization, a couple more trillion in the works already in terms of the stimulus package, and this is happening around the world. There's a lot of uncertainty, and that's why it's hard we could all get bogged down trying to assess or project what the next 6 to 12 months look like, and no one really knows. We're living it in real time. So that's why, coming back to the beginning of this discussion, being able to look out ahead and say, what do we need to do to bridge us through this gap, not knowing how deep this gap may be, allows for us to continue to make progress amidst the uncertainty that we face.
Yeah, so I don't agree with you entirely, because I don't believe that this was a surprise. That cracks are signs, and then when they become into sinkholes, then that's when they raise people's attention. But last year we saw Dean Foods file bankruptcy, which was the largest dairy producer in the country. And we saw the USDA issue loans to farmers of $12 billion in August of last year. And we're seeing farmers file for bankruptcy with the trade war that was going on for years already before we entered. So these were all signs, and I think that there's already been a ton of contraction across multiple industries where the pandemic just triggered the global recession. But I think that there were already recessionary pressures and recessionary times across industry. And again, the number of bankruptcies that we saw across the agriculture industry is a sign of that. And just one more point that's important to mention is a lot of these credit farm loans that have been issued to farmers to keep them afloat are buried into money market funds that we all deem as conservative and safe. And so that's another point that has led to the credit crisis that we're seeing today. So I think that there's just so many issues that we want to focus on potentially one to say, well, nobody saw this coming. But I think that it's been here for several, I'd say close to over a year. And it's just now, this has just been the trigger to make it a global recession and tie it in, because Germany's been in a recession since last year. Most of Europe, Greece hasn't really been able to get out of a recession. And so I think that we've been in one, there's just been so many signs. This is just a sinkhole that triggered it.
I would agree with you, Liz. Just I'm sorry, go ahead, Bob.
I was just going to say that just kind of, there's a lot of competing data and a lot of competing information out there in terms of where we're headed in the economy. And just to bring it back to your managing your personal, your personal economy is the most important, and gets back to some of the points Casey made earlier about controlling what you can control. And no matter what's bringing us into this recession, the fact, if you look back to 1950, we've had 8 bear markets. In the average bear market, we've seen a downturn of 35% from peak to trough. But on average, in the next 3 months, the market was up, the stock market was up 20%. The next 6 months, 30%, and the next 12 months, 46%. So the average recovery is 2 years. Now we've already seen a 20% comeback in a couple of weeks, much less 3 months. So, and in 08-09, over the next year, after we hit the Dow Jones of 6,400 in March, and the next year we were up 72%. So all those bear markets were caused by different things. And, we can go back to the .com and 9/11 and the banking crisis in 08-09. Now we have a pandemic. It's all caused by different things, but the markets tend to react differently. And the markets react with a comeback. And what's important to remember is the market is one thing, the economy is another. So we're going to see kind of reams of bad news coming out. I mean, already like this month, you're starting to see earnings reports, which are not looking great. And next quarter's earnings reports probably will look worse. We really need to see this, the health reports get better, and I think then we'll start coming back. But the markets will come back, and because they're looking forward 9 to 18 months, they're going to look past this short-term data, but we're going to see conflicting data for a while, and that's going to keep volatility going.
Yeah, Jeff, I just asked, I'm sorry, Bob, I just asked to pull up this chart real quick to your point. You know, it's the history of call it bear markets and then forward-looking returns. And just to comment, Liz, that we would agree that the economy was ripe for disruption, and we've been cautioning clients about the fragile nature of the credit markets, a world awash with debt, and that, you know, it's kind of like a severe drought just invites a forest fire. You don't know what the catalyst may be, but when you have a severe drought, you're more exposed to one. And so COVID-19 is really the perfect catalyst, especially alongside an oil situation that unfolded. It didn't get the headlines that it otherwise would have. But, you know, Bob, to your point too, is that markets have always found a way of recovering, and the difference between markets and the economy is really important because markets do turn in advance of when you would ever imagine, because the world around you feels horrible. And all the more reason for having that durable plan to help guide you through various decisions, because it's very easy to have emotions overwhelm, you know, what you might be inclined to do otherwise.
Right, and to Bob's point, in terms of the market and economy, as well as Casey being separate, that is very important to know as an investor, where we see these dire numbers in terms of unemployment and initial claims, continuing claims, and certainly on an economic perspective, they are dire. But when we think about Wall Street and we think about investing, they love job cuts because it shows that you're managing your balance sheet and that you're reducing costs and operational expenses. And so it's important to distinguish how that information will be received and how it's acted on within the two, because they are very different.
Great. I have a related question to this from the audience. Does this panel view there is a high likelihood to another Dow drop of 5,000 points once unemployment numbers update and quarterly profits tumble in Q2? The market seems to be short-sighted and ignoring this unfortunate probable reality. I think that speaks to what you're talking about, Liz. Is that true? Or?
Yeah, absolutely. I do foresee that we could potentially see the Dow decline another 40 to 50%. As we don't see any type of resolution in sight on a global level. So in terms of declines, yeah, I don't think that what we're seeing this week and the past week in terms of green on the screen here is anything here to stay. I really just think that these are just short-term market pops by participants that are trading on these on this information for the short term. But I think exactly as Bob stated, we're in the middle. Earnings season just started, and earnings and reports are awful. They're just terrible, and so they're not expected to look any better as the quarters come. So yeah, I just think that we're not. This is just the start.
Great. Does anyone else have a thought on a 5,000 point or more drop in the Dow, or is that something you want to think about?
Go ahead, Casey.
Yeah, I'd just say that it's take a step back for a second and say, okay, is your plan, is your situation durable enough to be able to withstand it? And so how do you address, again, coming back to the elements that you can control, so that if it were to occur, you're in a position to be able to capitalize on it, or you're in a position as to where you wouldn't emotionally react to it. The worst thing that can happen is an emotional reaction in the midst of one of those downturns. So could it happen? Certainly. Most bear markets have seen a bottoming process that takes a number of months. It's not the short V-shaped so-called recovery that we've experienced in the last, call it 6-7 weeks. But I would say worry less about what's going to transpire over the course of the next 3 months and focus more about what can you do, what's in your control. If it happens, are you okay? And can you capitalize on it? Or if it were to happen, are you in trouble, and do what you need to do to prepare? So
So along the lines of capitalizing on it, one of the things we're doing for our clients is we've been rebalancing our portfolios. So they have a target allocation between stocks and bonds, and we and international and all the different asset classes. So we've been regularly rebalancing. And so as the Dow, or as the markets have gone down, the stock markets have gone down, you know, at 10%, 20%, 30%, we're rebalancing to take advantage of those lower prices, you know, because we've made some profits in the bond area, took those profits, put them into the stocks. And as stocks rebound, we're going to see the benefits of that. So that's something that you can do and take control in your 401k. So most 401k software allow you to set an automatic rebalance on your 401k. So set your targets, whatever your target is, rebalance to that, and have the main thing is to have a disciplined approach to this, because as everyone's saying, we can't predict what's going to happen. We know there's going to be ups and downs, and if the market drops another 5,000 points, you know, you're buying in on a regular basis and taking advantage of that. If you're retired, you hopefully have that 3 to 5 years worth of money set aside already, so that you don't have to withdraw money from those stocks. You can withdraw from cash and fixed income to ride out the storm. So that's one thing. Another thing that we're doing is tax loss harvesting. So if you have money, if you have stocks in accounts that are not in your IRA or not in your 401k, then and the stock has lost 20, 30%, you could take that loss, buy into another stock fund or stock itself, so that when the market comes back, you're taking part in that increase. But meanwhile, you've captured that tax loss for your taxes next year, and you can write off against future gains or write off $3,000 of regular income. So there's strategies you can use to take advantage of this. So again, take advantage, you know, it's your personal economy that matters the most. So make sure you're talking to your advisor about strategies that can take advantage of what's going on.
Great.
Yeah, well said, Bob.
I have another question that's kind of related to this. The SBA is stating that they have exhausted the $350 billion in Paycheck Protection Program funds. That's for small business. What do the panelists think this will do to market perceptions if and when more money is added to the initial stimulus package?
Sure. So this will, of course, increase the debt load that the government is carrying. Certainly, I think that it's hard to ignore the 22 million unemployed Americans that we currently are seeing. And further, it's hard to ignore the fact that there's going to be a percentage of these 22 million that only have their retirement accounts to access money, so they're going to be forced to sell. So they can't hang on for this recovery. They'll be forced to liquidate, which is going to force the markets to continue to go down, because you're going to, again, have people selling their investments because they need the cash. So I think there's a lot, again, that is just yet to be seen. I think we're going to just continue to see a decline. I think that the government is going to continue to just invoke some more stimulus packages to just keep injecting cash. I mean, that's what the Federal Reserve and central banks are there for, to provide price stability and interest rate stability. And so if they see interest rates continuing to go up, because of the fact that there can only lend at these high rates, that's going to then drive prices to, of course, go down in terms of the bonds and trading, and it's going to just create more liquidity issues. So certainly, I again think that we're just in this for the long haul, and I just, I am concerned by investors that do need, and they're unemployed, and the SBA's program is just not enough.
Well, I think the as you can tell, the program's been hugely popular, and because they basically have run out of money already, so the 350 billion is gone, and hopefully they'll approve some more. And I think the whole idea of the program is to help small businesses keep people on the payroll. So without it, I think you'd have even more unemployed that Liz is talking about. So to the extent it can help businesses stay open and keep their people on payroll, I think it's a great program. Of course, we're going to have to pay the piper down the road. So taxes, you know, we have the lowest tax rate environment we've had in history. So again, in terms of your personal economy and what you can do about it, as markets are down here, it's a great opportunity to take maybe money you have in a traditional IRA and convert it into Roth IRAs or traditional 401k and convert it into Roth 401ks as the markets are down, because then when markets come back, if it's in a Roth setting, when markets come back, that's all growth that you're going to get tax-free. Okay, so when we have these dips, it's a great tax opportunity. So again, talk to your advisor about that. We're anticipating higher tax rates in the future, and if laws don't change in 2026, we're going to revert back to our pre-2018 tax rates anyway. So this tax environment we're in now is a huge opportunity for folks.
Yeah, I couldn't agree with you more. Is it possible to pull up slide 6? Because to that point, you know, I think two things. One is that the stabilization efforts that have already been announced, the $2 trillion plus, were really just stabilization efforts. There's more to come in terms of stimulus and assistance. This is going to require a Herculean effort on all fronts to be able to recover from, and hopefully in a more equitable manner for everyone, especially for the middle class. Tax rates today, to Bob's point, we are living in a very advantageous tax environment. So when we think about the things within our control that are going to add to our success or drive success, especially in a low interest rate world, the tax efficiency of our savings, of our investments, of our distribution strategies are a key component to that. And it's a component that is often overlooked by the public. But if you need to try to hit an average rate of return and your bond portion of the portfolio is delivering below average returns, equities are volatile, tax efficiency can help make up for some of those, for that lower return environment. So.
Okay. All right. I know we're almost at noon, but I have one more question for the audience, and I have one question that I have wanted to save. The one from the audience is a little more specific, but I think it might apply to other people as well. What are your thoughts regarding allocation balancing of existing funds, and would you do anything different with new simple IRA dollars going in? For context, we are in our late 50s. Anyone there want to try that one?
Well, I'll start. I think that, your age is one thing, but your time horizon to retirement is another. So if you're in your late 50s and you plan to work till 65, 67, whatever, then, you still can be looking to dollar cost average in to a heavier stock portfolio. And that's a good question, because, your existing money in your simple plan or your 401k is one thing, but new money can be another. So your existing money, you want to stick to your target allocation based on your time horizon. But if you have, some time on your side or you're younger, you could get a little more aggressive with new money going in, because stocks are on sale right now.
Sure, and I think with having a simple plan, a self-employed pension that you can set up, a lot of the times those are set up as self-employed individuals. So my presumption is that the individuals asking the questions are self-employed. And so my thought is to really, as Bob stated, think about what your time horizon is. How long do you see yourself working for? And are you maxing out your contributions into the plan that allow for you to invest those assets for that longer term? And if so, what is your asset allocation that you currently have? And is that in line with your timeline for investing for when you'll see yourself needing those funds? And then if so, how are the funds invested today? And is that new money going to match that?
Great. All right. I guess, Casey, did you have any thoughts on this, or should I just go to my final question?
Yeah, I think that was well said. It's really a personal process and aligning that risk capacity with the durability of a plan and emotional tolerance. So I'm good.
Okay. So first of all, before I ask this question, I want to thank you all so much for doing this. And, we've had a long conversation that might make a few people a little bit more, a little nervous, but not. I mean, I think you've all talked us off the ledge. But I would like to say this. I have this question. We know that this thing's going to turn around, but when do we know that we're actually seeing the light at the end of the tunnel on this? I mean, do you have any sense of how long it's going to be before we actually see some light at the end of the tunnel? And what is that going to look like?
I don't think so. I think it's just important to just remember that this too shall pass, and to consider what the needs are of today, and hopefully they align with your needs tomorrow, and then consider what is needed to get you through. And it's a very scary and dire time, and I know that as an economist, we're known to be quite dismal in our outlook, but certainly I don't think that anyone right now sees any end in sight, and I think this too shall pass. So we just have to keep reminding ourselves of that.
I would say that markets will turn before you see any light at the end of the tunnel, and being able to keep that in the back of your mind is really important when it comes to continuing to execute the discipline of an investment strategy. When it starts to feel good, or when you see the light, the bottoming process has probably already occurred. There's a line that says bear markets end with recession. And that is often true, as to where the bear market, the bottoming process is in place or on the other side of it by the time that everyone is going, oh, all the data shows that we've been in recession for 2 quarters, et cetera. So you won't see the light. Markets will see it before you do.
And I would just remind everyone that the average bear market, it takes 2 years to come back from that. So like everyone said, we could still see volatility. I think a big part of this one, the crisis we're in, is seeing cases, the COVID-19 cases drop and people getting back to work. I think that's going to be a great sign. But then, as soon as this kind of passes, we're into an election. Normally this time of year, this time of the cycle, we're talking about the election. We haven't really talked about that at all. So that presents some uncertainty. So there's going to be another thing down the road that's going to present uncertainty. So you just have to we're certain we're going to have uncertainty. You have to have a plan that includes cash reserve and includes a good time horizon to withstand all that. So I'd encourage you to, no one can spend any money right now. So use some of that money to build your cash reserve. And if the market drops, maybe you can take advantage of that.
Great. Thank you all very much. I want to thank Casey Snyder of the Sedoric Group of Steward Partners, Elizabeth Salas Evans of Cayena Capital Management, and Bob Bonfiglio of Rise Private Wealth Advisors. And also I want to thank you all for listening in. And I want to thank also the New Hampshire Business Committee for the Arts for sponsoring us. Once again, thank you so much, Casey, Liz, and Bob. And thanks everybody out there.
Thank you, Jeff.
Stay
Thank
healthy.
you, Jeff.